The main situation here is that the properties that we're going after, and I totally agree with you, Sam, the average person would think just like that, right? Like, hey, I'm not going to want to do that. I'm going to want to make sure I got you on the hook and all this. The properties, the difference is the properties we're pursuing and the sellers we're pursuing. There's either going to be a problem with the property and they can't sell it. There's going to be a problem with the seller and they need some quick relief.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Terry Hale is a commercial real estate investor, author, and mentor of 25 plus years in the business. Terry, welcome to the show.
Thanks, Sam. Thanks for having me.
Pleasure's mine. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Where did I start? So I started off, I'm a third generation contractor, saw my dad working his fingers to the bone, decided that I didn't want to get dirt underneath my fingernails. So we were doing a big job development project for a very wealthy individual. And I begged and pleaded for his help. And he put me to work and I worked for 5%. And I learned the rich man's game. That's where I started off. And I realized quickly once I got my financial legs that my debt to income ratio was hurt because I guaranteed too much debt. So I had to reverse engineer my thought of how I can pursue these deals. And I stopped buying property utilizing a capitalization rate. And I started looking for distressed properties that have lift, that have upside. And where I am today is very successful. Already came back out of retirement. And now I work with people one-on-one. And we move forward and we mainly acquire recessionary proof properties like multifamily, self-storage, and mobile home parks.
That is a lot of moving pieces. 25 going on, I think you said 25 plus years there in your bio. And I know it's been longer than that, probably over 30 at this point. From what I understand, most of what you've done has been a pretty non-conventional approach to buying assets. Is that right?
Yeah, I had to, because in the beginning of my career, I was just, again, buying on cap rate. So I would look at the gross income. I'd look at the itemized expenses, the property's expenses. I'd look at the net income. Simple formulas, the NOI divided by the purchase price equals the cap, right? Very simple. I was just buying too rich, Sam. And I had to reverse engineer and start looking at these value add plays, vacancy, low rents, mismanaged property, inheritance property, partners feuding, all those wonderful things that people want to sell.
Right. And so when you got into those, were you finding seller financing opportunities? Were you finding, there's a lot of hair on a lot of those deals. So break some of those down for us and how you've used that as a springboard to really, the rest of your career, it sounds like you've spent using those same strategies.
Yeah. And the strategies continued to evolve, just watching and seeing how people are buying businesses and just looking at creative ways. Like I just continued to, go back after I closed a deal and realized that, it's going to be a little bit of a challenge. And I knew it was a challenge at a time, but, it's just going to be a challenge of time to reposition. So we actually went back and worked at deferment of payment where it actually stops the payments and puts the actual monthly debt service to the end of the loan. So they're still going to make their money, but they make it later, which gives us an opportunity to free up capital and kick in the marketing and efforts to fill the vacancies. But yeah, some deals have seller financing right out of the gate. Obviously, it's Sam, they would because they don't qualify for bank financing. Something that's sitting at, say, 50% occupancy, any lender, regardless if it's a conventional lender or a private lender or hard money lender even, they're going to look at it and say, wait a sec, this thing has, like you said, a lot of hair on it, and we don't want to take on that risk. So they're going to want someone to buy it and come in with a ton of money, where it just makes sense for us to approach it from a seller finance aspect. But for the listeners, I want to give some value add to that. When I was personally guaranteeing these deals, that's what hurt me. That's where I hit the ceiling. My credit was good and I still had cash reserves in the bank, but I just guaranteed too much debt. So that's why lenders were shying away from me. So I would encourage all the listeners, whether you're doing residential, commercial, or buying businesses or doing anything where you're making money, try not to get personal guarantees. It's non-recourse structure. And when you're doing a non-recourse, that means that you're actually signing on behalf of a company versus putting it all the weight on your own shoulders.
Right. Yeah. And you've been in this business long enough to have weathered the '08 crisis where a lot of people got hammered because of their personal guarantees that were out there. How was your portfolio structured differently such that maybe you didn't suffer the same effects that other people did?
Yeah, it was big bad banks, man, with those negative deferred amortized loans. People, you fog a mirror, you get a loan, right? That's what we're talking about. I stopped when I went into retirement in my late 30s. I was already doing non-recourse structures. When I came back into the game, I realized, Sam, that people, they want really good deals, right? And when I resell these, I'm not selling these at a heavy retail price. I'm still selling them at discounted prices because I've created so much value and being able to buy it with creative structures. So one of the things that I did during that whole 08, that whole upside down situation, I was all set up in non-recourse structures, but I also did a very slick technique on all my contracts where I had the contracts written in a way as such where they said that they are assumable, transferable, non-recourse seller finance notes. So what that means in layman's terms is that I can actually take that deal at any point in time because everything's for sale but the wife, the dog, and the kid, right? So if somebody wants the deal, I can actually take all that work that I put into it, working smart and putting the deal together, and someone else wants it, they can step right into my shoes and just assume that non-recourse seller finance note.
Gotcha. That's very, very cool. I love that. Tell me, about this. You're still using, I think today, 2 strategies for profit. You guys kind of have 2 separate parts of your business. How are you finding opportunity, especially as it pertains to these 2 strategies? Can you break those down for us and then tell us how you're finding opportunity in that?
For sure, Sam. So I did author a book, and the name of the book is The 2 Best Strategies to Profit with Commercial Real Estate. And the one strategy to profit is everything that we write is always going to be, and I said this earlier, put into a company, right? So our contracts are written in a way where it is, buyer, Terry Hale, or one of my companies, but it's always going to be and/or signs. So what that does is that gives the person who has it written in and/or signs the ability to assign the contract. So one of our strategies when we start going through our due diligence, which typically could be 30, 45, 60, sometimes even 90 days, if we find that there's money in the deal, of course, because we recognize that up front, but that the juice just really isn't worth the squeeze. We don't want to put our time and energy there because time is money, right? And we could focus on something bigger and better that's going to produce more money. So some of these smaller deals, maybe in a smaller tertiary market, out in the sticks, we just decide that it's a good deal, but it just doesn't fit our model. So that one strategy, we just assign the contract. It's basically flipping or wholesaling commercial property, but it's done in a way where you're not putting any of your capital at risk because all we do is put up an EMD, which is earnest money deposit. That earnest money deposit is always going to be refundable. And if you're slick enough to do what I do, you never put that money at risk because you have something called a unilateral clause. And when you write it in the contract that the deposit is put down and that you're utilizing a unilateral clause, it's unilateral, meaning it only takes your signature to get your money back. So no one can actually tie up your money. And you always make sure in the contract that there is a specific performance box. Make sure that that is always going to be unchecked, meaning that they cannot sue you if you decide to pull out at the end of the day. You have control of your earnest money and they can't go after you for specific performance because you didn't perform. So that's one strategy.
Most sellers, I'm asking for a clarification and/or tell me why I'm wrong. Most sellers, I would think, are savvy enough to look at a unilateral clause or a specific performance, clause and just say, we want that in there. Terry, I don't want to do business with you. Thanks for the earnest money. I don't care if it's $10 million, but I don't want you pulling out at day 89 of 90 and then walking. So, I'm not working with you. How do you overcome that?
It does come up from time to time, but not as often as one would think. When it does come up, we just let them know that that's the way we do business. And if it doesn't work for them, if time and circumstances changes, circle back and let us know. We wish you the best. We're not really pulling the wool over people's eyes and trying to sneak stuff through. We have a very high level of ethics and integrity here in my firm. And I've always practiced that throughout my entire career, and I always will. The main situation here is that the properties that we're going after, and I totally agree with you, Sam, the average person would think just like that, right? Like, hey, I'm not going to want to do that. I'm going to want to make sure I got you on the hook and all this. The properties, the difference is the properties we're pursuing and the sellers we're pursuing. There's either going to be a problem with the property and they can't sell it. There's going to be a problem with the seller and they need some quick relief. As I mentioned earlier, partners feuding, ill health, just out of gas.
Right.
And it comes down to the story on the reasons of why they're selling. Once you deal with a motivated seller, man, I'm telling you, that's stuff that they could care less about. They just want you to perform, and they're going to play by your rules if you're showing them that you have the ability to perform.
Right. Absolutely. Which brings me to my next question. As far as I can tell, every asset class in commercial real estate is just on fire. And I know you brought up some, points here where you say, hey, there's partners feuding, or there's, sickness. There's all sorts of reasons why someone becomes a distressed seller. How do you find those distressed sellers? And then I guess on top of that, why don't they just put it out to market? I mean, right now stuff's just selling for stupid prices. So why not just punt it through the traditional channels?
Yeah. So a lot of times in hot markets, and the market is exceptionally hot right now, there's no doubt, but we are still locating off-market projects. And the way we market to these people, and a lot of people are doing the same, is you can purchase lists. You can go on platforms like Reonomy, and Reonomy is a platform where you can get cell phone numbers direct to the seller. But the thing about that is, Sam, and you know this, right? Because I'm sure you're like me, where we're victims in a sense, because we've been handed a book and we've neglected to read it cover to cover. We get that gratification right out of the gate that we have that book, we have that knowledge in our hands. But until we digest that knowledge, it's still useless. You actually have to digest the knowledge and then apply the knowledge to be able to get the results. Most people are result driven in their mindset, but they just don't make the connection and follow through. And that's just life. That's why that's that 3% rule, that only 3% are actually controlling. The rest of the people are the foot soldiers that are out there kind of, making things happen because they're being delegated the responsibility and they're given direction and they're following that direction. So my point is, one would think that even in a hot market like today, that there's tons and tons of competition. But it comes down to also relationship building with brokers, beside the fact of doing direct mail or making cold calls through that Reonomy platform, or any other way that somebody may use the search engine like Google or Bing or whatever to actually locate property, go on LoopNet, Crexi, City Feet, all these different ways that you can find these deals, Argus, all these places for self-storage, mobile home parks, mobilehomeparkstore.com. It's also noting that someone out there is advertising to the marketplace, like you said, slap it up online. Why don't they just sell it? A lot of people just aren't looking for those huge value add deals where it's going to take a bunch of capital to put in to reposition. Plus, they don't have the connections for third-party marketing management collections to make that happen. And they don't have a team underneath them to really take it serious and move it forward. So we're still finding very, very juicy deals. The second strategy, the one, of course, is the wholesale strategy. The second strategy is to really capture that lift, that upside. And we won't typically touch a project unless it's got 7 figures. So it has to have $1 million upside for us to really get involved with it, to say to ourselves, okay, we're going to close this deal with capital. We're going to bring on all of the moving parts, both the physical, automate modernization, and then also the online web presence and all of the way to connect to that third party. Put all that energy into it. That's repositioning. When we reposition a property for tax reasons, we hold it for 12 months, we stabilize it, we create 3 things, which everyone wants, which is a trailing 12 months, a rent roll, and a profit and loss. Once we have that intelligent data, we can go back to market, we can slap it up and sell it at retail price, and then we create that lift and make all the money.
Right. That makes a lot of sense. When you look at where we are in the marketplace, and you guys are obviously, you've got your own creative strategy for finding opportunity. But as you look at and we're going to, just sort of broad brush here. When you look at investors at large and you see the kind of investment philosophy that's going on in the market right now, and especially in this really hot market, what are some mistakes you feel like investors are making right now? So
I've done a deep dive into the way people purchase property. And as I was purchasing property and my original mentor was doing it. And when you're buying property and you're paying these crazy numbers that we just discussed, you're buying it, like out here, California, crazy Malibu, California, where I'm located, you're at like 3 cap, 4 cap. I mean, you're not going to make money The only thing you're doing is playing appreciation and taking advantage of some depreciation aspect. You're lacking in the 4 reasons why people should buy property to begin with, which is appreciation, depreciation, cash flow, and then to do the cash out refinance, right? So I see that a lot of people are just overpaying for property. They're not looking at opportunity in growth area. For example, we just wholesaled a deal in Montgomery, Alabama, and somebody would say, well, why go to Montgomery? Well, look, if you don't have your fingers on the pulse and understanding exactly what's happening in certain areas, we knew just because it was public knowledge where money's going. And there's a couple $100 million going into the Montgomery area. That tells me something, right? It tells me something. So when we see things like this happening, or the Panthers are slating out in South Carolina to put in a $32 million arena so they can do workouts and have their athletic field, and we know that money's coming in to little areas like Rock Hill, South Carolina, and you see a self-storage facility sitting in Rock Hill, South Carolina, well, guess what? People are going to want that deal.
Right.
And dirt around it too for expansion. So just being in the know, and I always say common sense isn't so common. So
I mean, those are some wildly different projects in very different places. How do you stay in front of it? I mean, that's a lot of moving pieces across a very big country.
Yeah, well, as they say, the size of your net worth is due to the size of your network. And I encourage everybody to do that networking aspect. I mean, just me meeting up with you and having some common ground, off topic of this podcast, we could have future discussions. And next thing you know, we're chatting up about something big that's coming into Tennessee in a certain area. And all of a sudden you're like, Terry, put your team to work. Let's find some property. And then voila, there it is. Boom. We land a handful of properties and, sky's the limit, man.
Absolutely. Tell me about this. I want to circle back on this distressed real estate question a little bit, because I didn't clarify this the way that I really wanted to. Sure. I used to buy distressed single family property. I actually cut my teeth for the first 6 years of real estate, only buying at the foreclosure auctions. I can spot a foreclosure right now a mile away. It's like, oh, okay, yeah, the gutters are overflowing, the grass is high, the trash cans don't come out every week. It's, the paint's peeled. It's like you can just pick them out. Like once you start buying them. I would say that it's probably not as easy in the commercial real estate space, because you don't necessarily know when the partners are having a feud or when someone's suffering from ill health or things like that. How do you build that funnel for properties that you want to go after? You say, hey, these are potential properties that could have distress.
Sure. And that's like the shotgun approach due to the rifle approach, right? So if you're doing the shotgun approach, then you got to kind of pick it apart and ask the right questions to be able to get to that. There really isn't, a website out there that just has, commercial, right. Deals out there that are distressed. Unfortunately, I'm waiting for it, right? When it's there, it'll make things a whole heck of a lot easier.
Or terrible, because the deals will all go away.
Yeah, exactly. Everybody will be jumping on them,
Right.
So there's a couple different ways that we approach this. And one of the ways that is the easiest, right? I'll give the path of least resistance, is creating these relationships out there with brokers that are specialists in that particular type of product. So I'll use self-storage, for example. Self-storage, there's over 50,000 self-storage facilities across the nation. These are not corporate conglomerates. These are not your CubeSmarts and your Public Storage and all the new big dogs that are out there. These are not the climate controlled new generation storage. There's 50,000 self-storage facilities that are out there that are second, third generation. Second generation meaning the non-climate control roll doors and also the barn doors that still squeak open and close, right? And fall off the hinges. Got it?
You're right.
Now, out of those 50,000 facilities, statistics show on even Storage Brokers of America site that over 85% of those are owned by independent operators like mom and pop. Okay. Out of that, what we find, Sam, is the majority of those are lacking in being indexed on Google, having websites. It's all drive-by traffic, and people don't even know they're there. And to test that, any listener, you can go right outside the outskirts of your area. Because remember, the secret sauce here is that self-storage, the particular property type we're in discussion of right now, that is an industrial zone property.
Right.
So most of these are kind of ugly. They're boxes on dirt. They're not too aesthetically pleasing. It's not like you're looking at something that's all that appealing. So they're made to go outside of the master plan community. So they're on industrial zone roads. If you locate one storage facility, chances are, and you've seen this driving on the freeway, you drive down, next thing you know, you see another one, you see another one, you see another one, and they're kind of all somewhat clustered in a particular area.
Right.
Most of those that are out there across the nation do not even have websites. So brokers can do door knocking, and you can search the area, and if they do have some type of advertising and they're using something like Sparefoot or something like that, you can find them as well on there. But driving for dollars, the old-fashioned way for brokers, we're finding that mom and pop are out of gas. But we also use these list brokers, and you could get really detailed information, Sam, from these list brokers, like how long the owners have owned them for. So if they've owned self-storage facilities for 15 years, chances are they're tired of waking up in the morning, stretching and yawning, grabbing their Joe and rolling back into the box and sitting there and staring at the television all day long,
Absolutely. That's really interesting. I mean, that you say that. I mean, when I think of self-storage, I think of still a fragmented market, but I also think of just one step behind multifamily in its competitive landscape, in the sense that there's so much institutional money pouring into it, and you're dispelling a lot of the myths probably that people like me that aren't in self-storage probably hold, unreasonably so, like that there still is huge opportunity in this space. So I think that's really, you've given some really helpful insight and information there certainly on that front. So yeah, I appreciate you giving some insight on how you guys are identifying opportunity, and in this case, just particularly in self-storage, and how you're working with brokers as well. I mean, that's the key we hear on this show all the time, which is that the brokers hold the keys. So getting to know your brokers is certainly the path to success. Terry, I appreciate you coming on. Is there any last thoughts you have for our listeners before we sign off?
Hey, we can all take it with a grain of salt on what people are sitting here with their predictions of what's happening next. We know that there's inflation. We know that gas is up, right? Gas prices are. I just got back from Florida, man. It was like $4 and change a gallon, and out here in California, we're almost at like over $7.
Wow.
I know. So like, how do you justify this stuff? I think it's just willy-nilly, man. It's just all out there. So I say focus on the recessionary proof property, like the multifamily, the self-storage, and even mobile home parks. There's plenty of those out there. And just take some action and get out there, create those relationships. As I said, get educated in that expertise of where you want to gravitate towards. And commercial real estate has made more multimillionaires than any other product that's out there still to this day, even with the new crypto stuff and all that happening. It's a rock solid business, and it's real estate. It's real. So I encourage everybody to get to it. Yeah.
That's cool, man. Terry, thank you for coming on today. Certainly appreciate it. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Yeah, they can go to my website, which is my name, which is Terry Hale, TerryHale.com. I'm huge on support, Sam. So my email is very simple. It's support@terryhale.com. If anybody wants to reach out and have a quick chat, see if we're a fit, see if I can help you get in the business, I'd love to do so. That's what I'm here for. And I appreciate you having me on, Sam.
Awesome. Thank you, Terry. Appreciate it. Have a great rest of your day.
Yeah, you too. Thanks, man.